So wanted to understand that from your experience, what are the five main factors when you should be considering when you're looking into the multifamily?
Yeah,
Yes.
absolutely. It's a good question because it does change
Mhm.
over time. In real estate is it's not stagnant. I mean, it does change that we are at a certain cycle, and then five factors that can make or break a deal are essentially they can change over time. Um, when when it comes to this topic, and I'm very data oriented and kind of data driven.
Mhm.
Um, so the five factors that actually impact that can make or break a deal, a lot of it is coming from the underwriting and how one essentially is reviewing it. And even as a passive investor, you know, passive investors usually don't underwrite deals, but I think by asking certain questions, they can increase their chances of accurately valuing whether this is the risk that they want, a risk that they want to take. Um, the truth is that you can put any deal and any deal can look great on paper. If you just move, rent growth or occupancy, then all of a sudden an 11% IRR deal looks in like 18%.
This is the Real Estate Wife Show, and I'm your host, Vinki Loomba. As a real estate investor and a fund manager, I'm always excited to explore the world of real estate opportunities with you and for you. Today, I have a very good friend, Ellie Pullman, with me. Welcome, Ellie, to the Real Estate Wife Show.
Hi, Vinky. Very, very happy to be here today. Thank you for having me.
Likewise. So a little bit about Ali. Ali is a founder of Blue Lake Capital and a powerhouse of world of real estate investments with over a decade of experience across law, property management, and multifamily assets. Ali has led Blue Lake Capital to manage over 3,900 units and achieved a stellar $1 billion in transaction volume. Wow. I'm super excited actually about your journey. And today we're going to be discussing one of, I think, your favorite topic, five key factors to make or break multifamily investments. In this episode, we'll dwell into the world of multifamily investments and uncover the key elements that can make or break your success. Multifamily properties offer tremendous potential for building wealth, but navigating this market requires both strategy and insight. And that's what we're going to learn from Ellie today because he did awesome job. We'll also explore five critical factors from deal analysis to financing strategies. And every investor, I think, should know this already or need to know this basically. That's what we're going to be dwelling into. So, Ellie, I'm going to start with the first question that I read in your bio. You came in as an immigrant. So as an immigrant, you have built a fast-growing company. How has been your, experience like? What influenced you to get to this level, or what kind of challenges or advantages you have seen through all this time?
Well, I remember before I came to the States, back in college, I was studying actually the US history, and the professor taught us about the self-made man concept. And I remember sitting there and thinking, how about a self-made woman? And I'm gonna come to the US and I'm gonna build something. I didn't really know what it was exactly. Um, but from a very young age, actually, I wanted to be in real estate, and it took me a long time to kind of connect all the dots and decide, okay, I want to come to the States. I want to be in real estate, and the path is not always, a straight line. So you asked me how the journey has been for me. It's been, exciting. I think, even when things hard sometimes, I do wake up grateful that I'm in this great country and not anywhere else, where in other countries, you don't necessarily have the opportunities that you have here,
Mhm.
where I do believe that if you work hard and you're dedicated, you will succeed. Even if it's not a straight line, even if there's some challenges along the way, you will succeed. And that has been my journey and my experience. And I don't take anything for granted. Even we're buying multifamily assets with investors, so even getting a 50%, 60% loan um from a lender in other countries, they don't have that product. Things that we take for granted. I come from Israel. It's a great country, but you can't really go to the bank and say, I have a $50 million building. I want 20, $25 million loan. There are very, very few families there that would, or big companies that would get loans in that size. So I just think that it's pretty amazing to be here and to enjoy the opportunities that this country has to offer.
Yeah, that's true. I agree with you 100%. And the other thing that you said is, even though things are not working the way you wanted, you always been grateful all your life. I think that's the biggest thing in there. Because even you are feeling grateful for the challenge or the opportunity, it just like opens up many more doors for you.
Yeah.
Even if it's a challenge, God gave you that challenge. I'm going to use the word God over here. But whosoever you believe in, when you get the challenge, if you feel like, oh, I mean, you felt the higher power or the God felt me that capable to face this challenge or, just conquer this challenge. I'm grateful for that. Many more doors open, and I believe in that 100%. So you said you wanted to be in real estate from the very get-go. You kind of knew, but why multifamily? Or how did you get started?
Um, actually, I didn't really get there very quickly. I started with why real estate. And I grew up pretty poor, and my mom was very sick. I was taking care of my siblings, and my dad was struggling to provide for the family. And so we were in very tough situations. And I remember as a kid thinking, I need to get out of here, but I didn't know how. And I remember that the most famous families and corporations around me, they were all in real estate. So that's how I got into thinking about real estate from a very young age. I didn't think about buying anything, and all I had was my brains. So um, I worked really hard to get into a top law school, and I started working at a real estate department there, real estate part of the real estate team, and I've learned a lot. It was also 2007, so it was very, very interesting time to be an attorney. Um, but when when I moved to the US in 2014, and I got an MBA at MIT, and 2 years later, I flew all the way from Cambridge to Los Angeles. I wanted to move here. And shortly, I think about a year after graduation, I started Blue Lake. That was in 2017. Um, Before I started Blue Lake, I knew that I said, hey, okay, let's go back to real estate, because I did a little bit of tech. I got the tech bug at MIT, and I worked for a tech company. Um, and so I essentially, I was thinking, okay, should I do fix and flips? Should I, do buy and hold, buy single family homes? And coming from business school, I'm very used to think about scaling, and it just didn't scale. One house after another. I very quickly learned that you cannot get more than 10 mortgages, and then they said, okay, bring your spouse, and then they can get 20. Well, my husband was not interested in real estate, and I want to create my own company, not involve him, and I love him to death, but I like the separation. Um, and it just didn't scale. And so I started listening to podcasts, started reading, started educating myself. And one of those podcasts, I heard about multifamily. And I remember this moment because I was in my car waiting to I was driving to this fix and flip. meetup or conference, and I was sitting in my car. I was late because I was so fascinated by what the podcast was about when they were explaining the math, explaining how to do it at scale. And it's like when you meet, someone and this is it. I just knew that this was it when I was listening to that. So that's how I knew that this is it for me. And then, of course, I love data, and I spent time studying whatever I could about it. I mean, I took also real estate classes back at MIT, but nobody's really teaching you how to raise money. Nobody's really teaching. There's such a huge gap between what they teach you in school and how real estate really, works. They're not teaching you how to manage the property managers. So on one hand, um they don't have too much flexibility to do whatever they want because they're never going to treat the asset like you would. They never care as much, and on the flip side, hold them accountable but not make sure that they're not, and make sure they're not overly pressured. So because then they also don't perform. All these things you learn when you actually do the work. um but that's what got me into multifamily. And I started by partnering with another company. And slowly I started taking more and more with every deal that I bought until, that was years ago. But today we do everything in-house. We do acquisitions and dispositions in-house. We do asset management and investor relations and capital raising. So everything is in-house, but it didn't start this way.
That's true. Start small, but gradually get there. But what share with us one thing that intrigued you into multifamily when you're listening to the podcast, one thing that just like caught your attention so much and you said, oh, this is it. Because there's like jillion podcasts out there, and everybody has a different perspective. So
Yeah.
what was that one thing that kind of resonated with you and you're like, okay, this is it now?
Yeah,
I
when the
go on.
guest of the podcast was saying, um he was being interviewed, and the interviewer was actually a single family home investor, and he said, you work really, really hard, review documents, review your diligence for one door. I do the same amount of work, maybe a little bit more.
Right.
Um but I'm buying 300 doors at the same time. So obviously it's a lot more work, but
Mhm.
that's what clicked for me. Said, wait a minute, 300 doors. And that sounds interesting and exciting. This is something I can scale. And so I knew at the time that average cash flow was anywhere from 200 to 700 per door on a single family home. And then it kind of eroded down to 300 and 100. But then I said, okay, even if I get 200, $300 in cash flow profit per door, if I have 300 doors, now it's a different game. And once you do that, it's actually not much more work if you purchase 200 units or 400 units. It's the same amount of work. Um, so that's what was intriguing to me when he said that. This is, you do all this work for one door, and I'm not disrespecting that. It's definitely, everyone has their own angles. Some don't want to deal with monstrous, with huge um assets, and that's totally fine. To me, what's exciting is the scale, is the fact that you can buy something that, if you implement something and you do it right, you get 2%, 5%, 6% increase over a year across 300 doors. Now that's powerful. The multiplication of revenue by the number of doors is for me, that's what's exciting.
I agree with you. It's called economies of scale, basically,
Yeah.
Like you're gonna do the similar amount of work, but the value for your buck is much more. It's like all the vision, all the strategy. So over the years, with all the experience that you have gained, even your education too, you have a strong educational background as well. So from all that, you created, I think, your 5 factors for the multifamily success, how to make it or break it kind of thing. So that's our today's topic. Let's dive into that as well. So wanted to understand that. From your experience, what are the 5 main factors when you should be considering when you're looking into the multifamily?
Yeah,
Yes.
absolutely. And it's a great question because it does change
Mhm.
over time. In real estate is it's not stagnant. I mean, it does change that we are at a certain cycle, and then five factors that can make or break a deal are essentially they can change over time. Um, when when it comes to this topic, and I'm very data oriented and kind of data driven.
Mhm.
So the five factors that actually impact that can make or break a deal, a lot of it is coming from the underwriting and how one essentially is reviewing it. And even as a passive investor, you know passive investors usually don't underwrite deals, but I think by asking certain questions they can increase their chances of accurately valuing whether this is the risk that they want, a risk that they want to take. The truth is that you can put any deal and any deal can look great on paper. If you just move, rent growth or occupancy, then all of a sudden an 11% IRR deal looks in like 18%.
Mhm.
Um, and so I always encourage investors to ask the hard questions. So one factor that can make or break a deal is rent growth. Whether it's a 2% rent growth year over year, which doesn't seem much, but in today's market, it's not that easy to get. Um, versus 7%,
Mhm.
10% rent growth, even 5%. So that's one of the factors that can make or break the deal. Because if the deal works great with 7, 5, 7, 10% rent growth, but it doesn't work with 2%, then it might work, but there might be some pressure on cash flow if there are going to be a few years where you can't get those rent bumps. So that's one thing. And it's really amazing to see on an Excel spreadsheet how the yield changes when you just change that one tiny assumption. Um, and it's a rule of thumb, so there's always exceptions. So maybe there's a good reason why the deal can support 7% rent growth, but you got to understand the story. So if it's above 2 to 3%, then why do you think you can get 10%, 7%, whatever that is? It could be that it's a lease up and you're leasing the units up and you're catching up to market. It could be that it includes unit premiums after you renovate the units, and you need to ask for some comps to make sure that it's realistic. But rent growth is one of those factors. Um, the other one is the exit cap rate. And so cap rate is essentially the ratio between net operating income and the purchase price. And so whether you put 5 or 5.5 or 6%, sometimes this can make or break the deal. Many deals don't work with something crazy like 7 or 8% exit cap. But also it's important to understand that some markets have been trading at 5.5 cap for the last decade or so. And so just thinking, okay, I want to see how it works with a 7 or 8 cap. It's not realistic because this is just not the market. Um, but just make sure as an investor that you are comfortable with the assumptions of the exit cap. Um, and
Let
again,
me
if
ask you one question
yeah,
here first. So as a passive investor, like we're talking about the rent growth and also talking about the exit cap rate. So
yeah,
some of this terminology is kind of foreign to the passive investors, and even very savvy investors too, who are passive, they might not completely understand, they'll say, okay, there's a rent growth, but there's like very intricate or the fine details in that too, right?
yeah,
Like we talk about the physical occupancy or the economic occupancy, there's multiple factors, the market, the job, the population, like you talk about the fee from the renovation, how you're doing the rent bump, how much you're doing the first year versus the remaining years, how long the total project is. So all these are multiple things, from if you put your passive investor glasses on, what are the main things that you should focus on, or what would you advise the passive investors to pay attention to make sure that everything is kind of in line with their whatever they are projecting?
I would say if I didn't know anything about an asset class, I would um first and foremost look at the NOI, the in-place NOI, and then year over year NOI. Look at the growth. It's very easy to calculate. If you have 20% growth, that's very aggressive. But again, you need to understand the story. Maybe half the building is empty because it's 2024 vintage and you're leasing it up. But you want to make sure that it makes sense even if you don't understand much about it. So I would ask, hey, NOI, walk me through asking, the sponsor something like, walk me through your line of thinking of, how did you get to those numbers? And let the sponsor talk and let the sponsor, or, asking what data did you use to support your assumption? What are they and what did you use to support it? So let the sponsor tell you, well, we use 5%, rent growth, 2%, NOI growth year over year, and because we looked at A, B, C, D, and you can decide whether this is something that you feel comfortable with.
Oh, yeah. Thank you so much for explaining that. And similar goes for the exit too, right? You wanted to know what the exit strategy is. That's the number one question that I think every investor should ask. Because going in without having that understanding that if there's an exit strategy or there's multiple exit strategies, I don't think it makes sense, right? What do you say?
What do you mean by that?
Because see, a lot of times people they share the deals and there's no exit strategy, right? They're like, okay, they wanted to hold
Oh,
it,
yeah.
right? So you're talking about the exit cap. So I just turned into like exit strategy because the exit strategy is very important in every deal. You need to know because that's going to tell you exactly that it fits your timeline or no.
Yeah,
Because
absolutely. How are you going to get there? Who are you going to sell it to? So, for instance, we know when we buy, where do we need to be in terms of NOI in, year 4, year 5, and who is the buyer? Is it institutional? Is it another syndicator? Is it the family office? I mean, it's you need to know that. There's definitely strategy. I didn't see a deal without one, but maybe there are out there. But absolutely understanding the exit strategy. Are you going to refi? Are you going to sell? And sometimes some sponsors add refi proceeds in a calculation. I would say always ask if this includes refi or no, because I personally don't feel comfortable doing something like this because essentially what it means is, let's say you take debt for 5 years, but you underwrite a scenario that you bake into the returns to include refinancing after 2 years. And you say, well, in 2 years, we think we can refinance at X% LTV and Y% interest rate. And it's a little bit unfair because what if you can't? It's very hard to predict. I mean, there's so many things we need to predict as is. So if you add that, I think that it's artificially boosts the projections because then you have some return of capital, then that reduces the capital balance. And now you invested 100K, you get, let's say, 20,000 from the refi that may or may not happen. And your 100K now turned into 80. So all the returns are boosted up because they're essentially being calculated based on 80,000, not 100. But you may not be able to refi in 2 years. So I would always ask to see the calculation if I were a passive investor, calculation of returns without any capital event in the middle of the business plan.
hmm, that's a smart thing. Thank you so much. So what are the other strategies? Other three, right? We talk about two,
Yes.
exit
Yeah.
cap and the rent.
Yes. One of them is the property management team. I mean, a great team can screw up a very, very strong asset, and a strong team can take a challenging asset and bring it to a success exit. I've seen, and I've been in both. Um, and so what I would ask as a passive investor, who's the property management company? Have you worked with them before? Um, why have you chosen them? Share that logic. So for instance, We have a deal under contract right now, and we're keeping the property management company in-house, that not in-house, but the one that is managing for the seller, we're keeping them.
Mhm.
And we already see NOI growing month over month since we put it under contract. And so it's a really, really great company I've known for years. And so they have managed the asset really well, and we don't see a reason to disrupt that and bring another, company. So understanding that can really, shed some light on the decision making. So that's a big, big portion, just the people. Some sponsors say that a property management company is as good as their regional, because essentially they're people that sit at the property day in, day out. And then there's regional, who are kind of a floating managers. They move from one asset to another. They usually have no more than 7 assets. And some regionals are strong and some are less strong. So that can really, really impact the performance of the asset. And I've seen it several times. So that's I would say one big factor that can make or break a deal.
I agree on that 100%. And I think your business plan too, because business plan is very important, that kind of in line with your property management and your asset management team,
Yeah.
because you are your asset management team, right? If you're strong, you have the vision, you will work in sync with your property management. And if they are strong too, asset ought to perform. That's what I say. It's like, kind of a team sport, but at the same time, it's like you're betting on a jockey. If the jockey is
Yeah.
strong, horse will run. We'll make the horse run either way, whichever way you want it to go. All right, so let's move on to our number 4 one.
Number 4, um, and it's not new to many investors, it's the debt. The
Mhm,
debt can make or break. And I'll give you an example. When if you buy an asset and you put a fixed rate on it, and NOI is $100,000 a month,
mhm,
and the debt payments are, say, $50,000 a month, and it's fixed, then even if the asset is going through a rough time, and NOI is 70,000, it's still cash flow positive. But if you put bridge debt and 50,000 in debt payments went up to 120,000, now you're in trouble. And so, I think as an industry, the industry is moving back to fixed rate, which, I heard the question, why did sponsors buy assets with, bridge loan when they're much more, risky? Um, it's because the yields were higher at that point. And, when you take an asset with a fixed rate, LTV was, I want to say about, I mean, 45 to 65%. I
mhm,
don't, maybe close to 70%, maybe. Bridge lenders, so when fixed rate was 50%, bridge lenders were offering 60%. So it's still not that high. Of course, when interest rates went up, then that put a lot of pressure on cash flow. Um, but that's something that can make or break a deal. And good debt, when you have good debt, things need to, for the most part, need to go really bad in order for the asset, to suffer. Um, but that's one thing. And I'm not saying do not invest in in an asset that has bridge debt, loan on it. But I would encourage investors to ask the sponsor, do what is the plan if things don't go well? How much in reserves do you have? Do you have a rate cap in place, which essentially is capping the payments? And that's very important, because otherwise, you know, we have one of those assets, and the rate capped it at 5 or 5.5%. So it's not going to go beyond that because we capped it. Um, so that's very important, to assets. That's a pretty big factor.
It is, but I think sometimes, I'm going to ask you this question. Sometimes it makes sense to go with bridge too. Obviously, not a floater with a cap. And then because When you go fix, again, it comes to your business strategy, business plan. Because if you go fix, then if you're looking to exit year three, there's gonna be prepayment penalty at some
That's
point.
right.
So you're
That's
gonna be
right.
kind of in the same boat. So it's like catch 22, this
And
way or that.
that's right.
So it boils down to your business plan, what your business plan is and what it asks for. Accordingly, sometimes you pick a product, right? So I wanted to hear from your experience, obviously. So how do you handle those kind of scenarios?
Yeah, absolutely. So if you're taking a fixed rate loan that is longer than the business plan, then you need to take into account the prepayment penalty and make sure that the exit price can cover it and your investors will still make profit. But yeah, in some cases, 2 to 3 years fixed rate is very hard. And that's why I'm saying the bridge is not bad. You just need to mitigate the risk and make sure that you have, those things in place. So you're not just taking bridge debt and hoping for the best, but you have things in place such as reserves, such as rate cap or other metrics that or other forms that can help you reduce and control the risk. It's real estate is all about risk. We're
That's
not trying to make an investment with zero risk. There's bonds for that. It's all question of how much money would you put to lower 80% of the risk, because you can't take 100% of the risk. Again, that will bring you to 0%. Um, and so, it's interesting with real estate, there's that expectation to make money every month, every quarter, but this it's actually not what real estate is about. Real estate is about taking a risk, um, working hard to execute the plan. And for some reason, and I know the last decade has been really good to investors, maybe with the exception of the last 2 years. Um, but with real estate, you can't win every single time. And I'm telling that to our listeners, but also telling that to myself. It's hard for me also to come to to the realization that maybe sometimes at some point in the future something is not going to work out, and we're not going to exit at the price point that we thought we would. Is probably going to happen at some point. It's very hard to come to peace with it. But it just unfortunately, that's what real estate is. You can't always win 100%, but you do your best to do the right due diligence to buy the assets that you think you have a very, very high chance and high likelihood of exiting at a profit.
Esther, you said it very well. This is all about calculated risk. So we are not avoiding risk. We are doing risk mitigation a little bit, by doing all this, our financial modeling, financial analysis, like we're talking about the rent growth, our exit cap, the exit strategy, and then you're talking about what was the number four factor that we are just talking about?
Well, we
Um,
talk about the property management
the
company.
property
Yeah.
management and the debt, right? So
Yeah.
all these factors we take into consideration just to make sure that our business plan is so solid and we are able to get to the finish line in flying colors, right? That's the all calculated risk or the risk mitigation plan so that we have a huge profit, whatever we are projecting, right? Is there anything else that you wanted to add that I missed on?
No, I think that's about it. Maybe one thing that I would add is to have controls in place so you can see the trends when they just starting, rather than realizing 10 months later that something broke, and then it's much harder to fix. But when you see something trending downward, that you're able to recognize the numbers, recognize the trends. So you need to really, you need to track delinquencies or bad debt, occupancy, lease trade outs, and other, metrics, if it's work orders, etc., in order to understand if you have 3 months of declining, because 1 month can be a coincidence. 2 months, something might be happening. 3 months, that's a trend. Something is definitely happening. And you want to be able to step in and intervene much sooner so you can fix it right away. But if you're just looking at NOI and you're very high level and you're looking back, 6 months later, 10 months later, tracking NOI, but you don't know why it's going down and you don't get into the details, it's going to be very, very hard to fix it. So just being very granular and holding the property management team accountable, that's very, very much that's key.
Wow, that's like a crash course on multifamily. The last 20 minutes, basically. So I wanted to ask you this question. For the passive investors, from a passive investor perspective, how important is it to understand the financial model, or who's going to be managing the deal, who the property manager is? And I mean, and this whole numbers game, because most of the time they look at the pitch deck and it's like a shiny object. Oh, 20% return, 30% return, let me invest. But I think as a passive investor, they should need to understand, or they should understand the basics of the deal, like what kind of risk they are taking or how much risk they should be taking, right?
Yeah, absolutely. Don't be fooled by decks.
Mhm.
They, you know, the marketing team should not be stronger than the acquisitions team or the asset management team. Don't be fooled by the shiny designs. Look at the numbers. You can ask for the model. And if, we have proprietary models, so we share, PDFs so they can, because we don't want to share, the actual Excel, but we're happy to share the PDF so you can see all the assumptions, you can see everything. That's not a problem. Ask. And if the sponsor doesn't want to give it to you, that's a red flag. So ask for the short version or for the model. And it's a lot. I don't expect passive investors to sit down and just analyze different models, but just have a conversation, 30 minutes, 45 minutes, an hour with a sponsor, and then just ask, walk me through your line of thinking. How did you get to the NOI numbers? How are you going to push income? What are the main risks here? If bad debt is high, if it's over, I would say 2-3%, ask ask why. What are you going to do differently? What do you know about the tenants? Because it's sometimes hard to change tenant base, the tenant base.
That's
So
true.
ask, a lot of those questions. And yeah, I think you can learn a lot from just having conversations. Just OM can be a starting point, but it should never be the ending point when you are looking into investing in real estate.
That's true. I agree on that 100%. Other thing I say is always check the track record, because it's not the track record that we talk about in real estate, that I have this many doors, I have closed this many deals. Beyond that, go a little bit beyond that, build a relationship, trying to understand, what this person's pattern is. I say this all the time, so I'm going to say it again, that, no matter where you come from, how you've been doing things all your life, doesn't matter, you were in academia, you're in a corporate world, wherever you come from, when you come to real estate, you're still following the same patterns, no matter what. So it's like that's your track record, right? That speaks for you. So if you excelled in something in your past life, doesn't matter what it was, you're gonna excel here too. You're gonna do good over here too, as operator, syndicator, or whatever role that you're trying to play here. That's kind of so I think that's a true track record. That's the reason I say build strong relationships, get to know the person before you start investing with somebody. That's a really good thing. So next question I'm going to ask you about the market. In today's market, what creative deal structuring techniques are essential or that you're using?
We do get some off-market deals from some of our colleagues in the industry. Some of them are a bit hairy. Um, I still believe that to get the best deal, you still need to have very solid relationships with brokers, especially the institutional quality deals that we're buying. They get, they make a living out of getting to know all the owners. And so if they like us and they trust us, then they'll, we get sometimes, first look at deals. We get some off-market deals also through them. And so, you know, in terms of technique, it's just, I would say just stick to what works, and that has worked for us. Um, and it should work.
That's good. And I like that, building the broker relationships, because not necessarily all off market deals are good deals, like you
Yeah.
said with the theory. But the thing is, I don't mind paying somebody a little bit and getting the first dibs of the deal, and being that a good deal. A lot of times it turned out to be a good deal. So what do you see in your crystal ball? What is coming in multifamily? Is it
Um,
at the rock bottom yet, or is it coming? Because a lot of predictions out there, right?
I know, I know. I'm not really huge on predictions because I think it's it can make you focus on the wrong things. So always assume that things are going to break and just operate based on that. But I do think that there are going to be more investors allocating capital in Q1. This is not a prediction. I just know it from speaking with family offices and institutions that they are doing this in Q1. So they're back. Capital is back. Usually high net worth investors, they follow that. So I think more investors are going to invest next year. Um, I think rents in some markets they're going to stay flat. In some of them they're going to start growing. And even today we do see positive on some assets. We do see positive rent growth. So anywhere from 2 to maybe 7%. So it depends on the market. It's not 50-60% rent growth like we used to see, but it's still pretty good. Um, and then I think interest rates hopefully are going to go down. I'm still waiting for the Fed's next meeting, like everyone else. But I've heard survive until 2025. I don't know if it's how different the next year is going to be. If there's going to be a lot more capital chasing deals, that means that cap rates are going to be compressed. That's going to provide some opportunities for some interesting exits on current assets. But I think it's going to be an interesting year, nevertheless. I would say that's the only prediction I can make. It's going to be very interesting.
That's good. I'm looking forward to that too as well. We'll see what happens. Not
Yeah.
too very close. But anyways, we are out of time, but I have a lot more questions for you for the next time, maybe. But for now, can you share one golden nugget with my audience?
I think the most important thing is how comfortable you are with your sponsor and listen to your gut. Again, don't be fooled by shiny marketing materials. Just if you can meet with a sponsor face to face, that's even better. You're going to learn so much after meeting with them, and ask them hard questions. Don't be afraid. Ask them, tell me about a deal that didn't go well. Tell me about the worst asset that you have right now. What happened? Let them talk about it. They're trying to show that everything is fine. They either have no experience, or very little experience, or they're not being truthful. And so ask them the hard questions, see how they react, and see how and ask more questions about how they handle the situation, because that's going to tell you how they're going to handle the situation if they were in the investment, you know, with you and things didn't go well. And be patient. Real estate is a it's you need to be more patient with real estate. Things can go up and down, but the exit is what it, even with no cash flow during the hold period, or some cash flow, the exit can more than compensate for it. So that really what counts. And vice versa, if you have great cash flow but exit is not great, then the IRR is can be very low. So just be patient and get to know your sponsor, and don't be afraid to ask them hard questions.
Yeah, thank you for validating my point. Like I was saying earlier, people follow patterns, and that's what you just said. Thank you for doing that. So this brings us to our rapid fire round. I'm going to ask you 5 questions,
All
and
right.
you can answer it in one word or one sentence only. Are you ready?
One sentence. Okay, let's go.
All right. So, what is one of the most important thing that you have learned in your life, and how did your life change after learning it?
The most important thing that I've learned in my life is that family is more important than anything. How did it change my life? It helped me cope when things are stressful.
Yeah, you go back to family. That's a good answer. I love
Yeah.
it. Share one good book that you liked and you like to recommend to my audience, except Rich Dad Poor Dad.
Um, I would recommend to the audience, the one thing, the one
The one
thing.
thing.
The one thing, yeah, it's about how to focus on the one thing that can help you scale and be more effective. And it really helped me clean the noise of all the million tasks that I was doing. And that was a turning point in my career and my business that helped me really scale.
Great. Thanks for sharing that. In one word, what does life mean to you?
Live an extraordinary life. Otherwise, what's the point?
I love that.
It's only one word, actually. So extraordinary. That would be one word.
I know one word, but what would, can I ask a follow-up question? What
Yeah.
could be extraordinary for you?
Do things that most people don't do. Take the company to a great place, travel, educate my kid. I have a 2.5-year-old daughter, give her, different education that inspires her and not,
Limit.
put her in kind of the regular system to teach her how to do things like how everyone else is doing, kind of the same things, taking risks and not settle for, something mediocre in any aspect of life.
I love that. So just live beyond your limits. I love it.
Yeah, there's no limits.
That's true. I like that. No limits. What is your biggest passion?
Cars, race cars.
Nice, mine too. I love race cars too. Do you do race car driving a little bit or no?
Yeah, I took some lessons.
Ooh, nice. If you could turn back in time and talk to your younger self, what would you tell yourself and why?
I would say don't wait for the right moment to do something big. Don't overanalyze. Have a work on a solid plan and go.
I like that. Just do it.
Let's
Yes,
do it.
just do it. I love that. Thank you so much. So, how can people reach out to you, Ali?
Well, you can visit my website, bluelake-capital.com. You can Google my name, Ellie Perlman. And I think you can also get there. You can reach out to me, Ellie at bluelake-capital.com or info at bluelake-capital.com. Um, yeah, if you want to talk to me about my journey or one of our available investments, then yeah, these are the ways to reach out to us.
Thank you so much, Ali. I really enjoyed our conversation today. Thanks for coming to my show.
Absolutely. It was fun. Thank you for having me.